Welcome to another edition of the program. I'm Temple Ashaju. Thank you for joining us this weekend. We'll begin with some market stories, and of course, that's as it relates to the capital market news box. The Senate this week confirmed the new management of the Securities and Exchange Commission, which has Mr. Lamido Yuguda as its new Director General and nominees for the Revenue Mobilization Allocation and Fiscal Commission. The Senate President, Ahmed Lawan, made the confirmation after considering a report by the Capital Market Committee, chaired by Senator Ibikunle Amosun. The Senate also confirmed 5 out of the 6 nominees of the Revenue Mobilization Allocation and Fiscal Commission, RMAFC. The new appointees are Ms. Salamatu Bala, Mr. Alfred Egba, Mr. Adamu Dibal, Mr. Oladele Gwega, Mr. Bello Wamako, and Mr. Ahmed Yusuf. The Senate, however, suspended the nomination of Mr. Emmanuel Nwosu over an ongoing security investigation filed against him. Meanwhile, the federal government's third sovereign sukuk has recorded a 446% subscription after 150 billion naira was offered to investors at the bond market. According to the Debt Management Office, the high demand for the sukuk came from investors such as ethical funds, insurance companies, fund managers, and retail investors who staked 669.124 billion naira on the offer. Now, the third sovereign sukuk issuance follows the debut issuance of 100 billion naira in September 2017 and the second issuance of another 100 billion naira in December 2018. Proceeds of the sukuk are expected to be used for the financing of 44 critical road infrastructure projects across the 6 geopolitical zones in the country. Now, it's been 21 years of democracy in Nigeria, and June 12 yesterday marked the phenomenon, which gives us the reason to reflect on the role of the capital market in the scheme of things. Well, within the last 2 decades of democracy in the country, the capital market has seen its boom and bust cycle. Top on the minds of Nigerians, of course, is the stock market crash of 2008 and the recession of 2016. However, new asset classes have been introduced beyond equities and the integration of newer exchanges, which improved market infrastructure, which cannot go unnoticed. But it also would appear that there are still some low-hanging fruits that we will be hearing from the Professor of Capital Markets at Nasarawa State University, Professor Uche Uwaleke, who joins us now from Abuja. Professor, thank you for joining us on the program. Good evening to you, and I should say Happy Democracy Day. But what for you are the gains of the capital market in the last 21 years of democracy in Nigeria, especially if we prize in the fact that the late MKO Abiola, who played a key role in the democratic process of today, was once the president of the Nigerian Stock Exchange?
Yeah, that's correct, Temple. The market has come a long way since 1999 in terms of cocktail of products. The menu of asset classes has been expanded beyond the traditional equities and bonds. Today we have exchange-traded funds, and I'm aware that efforts are afoot to also put in place equity derivatives. That's talking about index options, index futures, and the likes. And aside from that, you also know that the infrastructure has also improved a great deal. I'm talking about the platforms now for trading. Now, before we used to have just the NSE, but over time we've had OTC platforms, notably the NAST and the FMDQ, which are doing well today. This is in addition to the 3 commodity exchanges that we have in the country today. That's the Nigerian Commodity Exchange, the AFEX, and the Lagos Futures and Commodities Exchange. So a lot of modernization has taken place. IT infrastructure, have been deployed to improve the system. And you can't but also mention some of the confidence-building measures the regulators have put in place. So regulation has also been strengthened. Measures including the e-dividend scheme, where investors now get their dividends in the bank instead of waiting for dividend warrants. You also have the dematerialization that has been, I think, near 100% now. These days, investors no longer carry fiscal certificates with all the attendant challenges and the risks associated with the fiscal certificates. Recapitalization of the capital market operators has also been done. So if you look at these measures, these raft of initiatives, they have a way of sending the right signals to the the investing community. So I think a lot has been achieved over time in the last 21 years. The corporate governance scorecard is also there to ensure that floated companies are better governed. So if you take all of this, you could say yes, we have improved significantly. But that's not to say that there are no challenges. The journey is still far. The 10-year capital market plan is still a work in progress. This is the 5th year now. And because these initiatives I've mentioned, flow from the 10-year capital market development plan. So if you look at where we are today, in terms of the size of our market, it's still small compared to the size of the economic size of Nigeria. That's the GDP. Less than 20% of GDP. The market is still constrained to contribute significantly to economic development. If you compare Nigeria with peers, for example, South Africa, where the market is about 250% of GDP. If you look at the stock exchange, for example, if you take the flagship stock exchange, I'm talking about the oldest now, the Nigerian Stock Exchange, you have just 157 companies listed, including the 9 on the ASEM and the 8 on the premium board. So, and if you compare that with what we have in Brazil, where you have hundreds of companies, or in South Africa, hundreds of companies, again, that pales into insignificant. So we want to see a lot more listings in the market. Good, the thing we have other platforms now. So public companies that are not listed on the exchange can also be listed on the NSE. And the FMDQ is also there. FMDQ has been doing well in terms of trading bonds and fixed income. So we have these platforms and alternatives available. The point I'm making is that it's important we attract more companies to the stock exchange, because that way we can help diversify the economy.
Right, it looks like we're having some audio challenge with Professor Uche Waleke. Let's see how we can reconnect with Professor Waleke in a few moments from now. But quickly, before we do that, let's look at what the markets look like on Thursday. Stock market was actually down 0.13% on Thursday. That's 13 basis points. But if you look at the week-to-date performance of the market, it was 67 basis points higher. And of course, as of Thursday, we closed at 13.13 trillion naira in terms of the equity capitalization of the market. That's after dropping by some 16 billion naira. Top trade for that particular trading session was GT Bank, that's Guarantee Trust Bank, which declined by some 82 basis points after transacting some 81 million units for a value of 2.02 billion naira. In terms of the top loser for the day, it was Keverton PLC, and Name It PLC, a pharmaceutical giant, continues to rise by more than 10%, by about 10% daily basis and the markets. For the activity level, we saw a decline of appreciation of 26% in terms of what we settled at. And of course, value of transaction also rose by 7% on Thursday before the markets closed for the holiday. And of course, deals was 3,880. If you look at the sectoral performance, we saw declines in the banking sector. Jai's Bank was down. Fidelity Bank contributed to the negative performance that we have there. Consumer goods, Honeywell Flour was down by 5% plus. Nigerian breweries saw some profits taken by some 1.18% and affected the sectoral performance of the markets. I understand we have Professor Uche Waleke joining us back on the program. Prof, can you quickly tell us now how reflective of the economy is the capital markets today if we look at the losses that we had seen in time past within the last 21 years?
Yes, the capital market is meant to be a barometer for the economy, but part of why it's not happening in our case is because of the point I was making earlier. The stock market, for example, is not having enough issuer base. The issuer base is concentrated, what I call unsystematic risk. If you remove the 8 companies that are on the premium board today, where you have the Dangote Cement and MTN, and you add, maybe you go to the main board and pick GTB, pick Nigerian Breweries, and probably Nestle. The market, is down. The market has collapsed. So we need to bring in a lot more companies in the market, to reflect the economic sectors that we have in the economy. MTN is there, but there are other telecom company giants too that are yet to list. Those ones can also be encouraged to list. In the oil sector too, there's no reason why Shell, for example, cannot be convinced to list on our exchange. Shell has a primary listing, as you know, on the London Stock Exchange, and secondary listings on the New York Stock Exchange and Amsterdam's Euronext. In Africa, Shell can be made to list on the Nigerian Stock Exchange.
We're running out of time, but we need to address some of these key issues. You're talking about the oil and gas companies. Should we be bringing these companies, the Shell and the other OICs that you mentioned, should we bring them to the market by way of compulsion? Or by what means?
Not compulsion. No, not compulsion. Incentives. But before the time runs out, let me quickly make this point. It's important we at least the one we own in Nigeria, NNPC. Let's take a fraction of NNPC to the market. Aramco is an oil company in Saudi Arabia. Aramco in December got listed on the Tadawul, that's the Riyadh Stock Exchange. The NNPC too can be listed on the stock exchange, especially now that NNP is talking about diversifying into power, into agriculture, into healthcare. This is the time to have a discussion with NNPC to bring part of a fraction of the NNPC to the market. Using a special purpose vehicle with natural gas, where the government has 49% interest. Part of that interest too can be taken to the market as a way of ensuring, inclusion, inclusiveness. Okay, so that the fortunes of these companies can be, well spread. It's also a way of diversifying the economy. So I think it's time we brought the NNPC in particular, on the exchange. That will trigger a lot of activities, in the market and generate a lot of interest. A lot of people now sitting on the sides, on the fence, will signify interest when you have a lot more of these companies, coming to the market. That's my take.
Right, Prof. We have some 30 seconds to go, but if you could address the issue of retail investor base in the market. I mean, if you look at the participation in the month of April in the market, it jumps over that of institutional investors' participation by 8%. But how much more do we need to do to encourage the participation of retail investors?
Yes, the percentage of retail investor base is still small. The key thing there is part of what I was saying. We should have a variety of products. The savings products that we have in the market today, is good, and many of them should be encouraged. One of which is the FGN savings bond that will have a way of attracting retail investors. Another key thing there is education. Investor education and capital market literacy, and that's why I'm happy that the Securities and Exchange Commission is championing the effort to inculcate the capital market studies in the curricula of not only secondary schools but also tertiary institutions in Nigeria.
All right. That will be more financial literacy and something that we hope that the federal government will start considering ahead of the next 21 years of democracy in Nigeria. Professor of Capital Market at Nasarawa State University, Professor Uche Waleke, thank you so much for joining us on the program this evening. We appreciate your comments. Well, you have heard about FBN Holdings' sale of insurance business subsidiary, but do you know why? Let us tell you more about this transaction after this short break. Stay with us. Well, the news of FBN Holdings' divestment of its 65% stake in FBN Insurance Limited to Sanlam Emerging Markets, a South African firm, is still a wonder to the investing public, at least in some quarters. Now, the financial conglomerate had in April announced its plan to divest the business, saying that It is in line with its strategic objectives. With the conclusion of the divestment comes the need to better understand the implications of the sale of the books of FBN Holdings PLC. And so yesterday on our sister program, Business Morning, we had this conversation with the Chief Executive Officer of Cowrie Asset Management, Mr. Johnson Chukwu. He gives us insight into the sale of the insurance line. Let's listen.
As you know, FBN Holding has the commercial banking arm, the investment banking and asset management arm, the insurance arm, and the microfinance banking business. So if you take out the FBN Insurance, then you basically see the other subsidiaries are largely banking services. So I think what the bank wants to do is obviously optimize its cost and focus more on its area of core competence. But interestingly, when I looked at the institution they sold, it is not principally because that FBN Insurance is not doing well. Because if you look at their 2019 performance, FBN Insurance contributed about 10% of their profit and about 6% of their gross earnings, which means what they did was obviously to step out away from an area they have considered as no longer core to their operations.
So let's look at the fact that they sold out the insurance wing, but left the insurance brokerage firm or insurance broker firm. What is responsible for that decision? Do we know?
Well, Temple, a lot of banks have adopted what they call back assurance. And that back assurance simply means because the core business of banking involves a lot of insurance. So the insurance brokerage arm will be involved in placing those covers with reputable insurance companies, including Salam, which is what FBN Insurance may become known as. So the insurance brokerage business will continue to complement the core business of banking because virtually all banking services require some level of cover. And that, since the bank could have been placing those covers with own insurance company alone, the brokerage company will distribute those covers to several insurance companies that are reputable, that can handle those things. So I think it is still integral to what the core business of their banking.
But in the end, what will this translate to in terms of bottom line for this institution?
Well, I think if you look at what FBN Holdings did, they just ended financial year, where their turnover, their top line was the third highest in the country. They did a turnover of 626 billion naira, just behind Access Bank that did 666 billion and GT Bank that did, Zenith Bank that did 662 billion. So in terms of the top line, they are doing extremely well. They are the third highest gross earning income bank in the country. But in terms of profitability, they made about 84 billion in profit. And I think what they want to do is obviously further enhance their profitability. We've seen a lot of improvement in their operational efficiency, but there's still a lot of rooms that they need to improve further on operating costs. So by stepping out of FBN Insurance, I want to believe that the liquidity realized from this will further go into their investment objectives. The bank is pushing towards fintech, and that will require a lot of investment, but that's where the competition will be. The competition is all about cost efficiency. It's going to be about leveraging on technology. And as you know, the bank has actually, bank's mobile application was voted as among the best in the country. So I believe they want to realize this fund. The money they will realize from this sale will further go into investment into areas like fintech, which are the growth sectors of the banking industry.
But do we have an idea of how much this transaction was worth?
Well, I don't have the figures, but if you consider the fact that FBN Insurance had a balance sheet of more than 100 billion naira, and an FBN Insurance had a shareholders fund of about 22 billion naira, which is above the new minimum capital requirement for composite insurance companies. So I want to believe that for the bank to have sold at this time, when that company is doing very well, they must have been offered what they make, an offer they could not afford to refuse. It must be something that was very attractive to them. Remember that Salman has been a co-investor in that company. Yeah. So for a co-investor to want to buy out the core investor simply means they must have seen some very strong opportunity, and they could only have sold if they got a very good consideration.
Mr. Chukwu, there are existing policy holders in FBN Insurance. There are also underwritten risks already. So between Salam Emerging Markets and FBN Holdings, who then bears these responsibilities now going forward?
Well, Salam Holdings, emerging market will actually inherit all the assets and liabilities. They're going to be taking over a company with a balance sheet of about 100 billion naira, shareholders one about 22 billion naira. So they will also inherit all the policies that have been written by FBN Insurance. Remember that Salam Holdings is one of the biggest financial institutions in Africa. They are in about 44 countries in the world, about 33 countries in Africa, and they are leading in about 11 of those countries in Africa where they operate. So I don't think any policyholder in FBN Insurance will have any reason to worry because the company is being transferred to an institution that is one of the strongest in Africa.
Mr. Chuku, before I let you go, we know that a lot of banks have been streamlining their operations lately. I mean, GT Bank has done the same thing, sold off some of its other subsidiaries. You also had that of FCMB, which also did away with all of those subsidiaries. But of what benefit is streamlining of operations in the current style of markets that we are seeing as opposed to universal banking style that we used to have before now?
Well, I think what some of the banks are doing is basically to focus on their core business area or core area of competence. I did mention earlier that by divesting from FBN Insurance, what FBN Holdings is obviously doing is to focus on their areas of core competence, which is banking services. The other arms that will be left, but for the brokerage, insurance brokerage firm, are banking services. You have the commercial banking, that's FBN First Bank. Then you have the FBN Quest, which is a merchant banking arm and asset management business. Then you have the FBN Microfinance Bank. These are also the retail or the small scale focused banking services. So the bank will obviously want to focus on its core area of core competence, which is basically what GT Bank did around 2012, 2014, when they sold GT Assurance.
Okay.
And then they also sold GT Bank, GT Mortgage.
And that's the show for this weekend. Thanks for watching. I'm Temple Ashaju. I'll see you next time. Bye for now.